Good morning. This is Todd Brand and Ryan Bouchard's joined me. We're appreciative that each of you are taking some time out of your day today to hear our thoughts on the first 100 days of the 45th President of the United States, President Donald Trump. We will, as you might imagine, focus less on the political climate and on the implications thereof, and more on markets, economics, issues that might have more impact on each of us as families or business owners or institutions. So to begin that process, thought it might make sense to give you a couple of quick updates. One, on your screen, you have the ability to type questions, which we will see. So please do that throughout the presentation, and in 40 minutes or so, we'll save some time at the end to hopefully answer those questions or speak to them to the best of our abilities. I thought a couple of data points might be interesting to open the conversation that are reflective of really where maybe not Ryan and I are specifically, but where the advisory community is overall. And I think they say a lot about some of the commentary that we'll come to in a moment. But at present, advisors in the United States, at least in April, 648 of them that were interviewed, expressed an unfavorable rating of President Trump at 51%. What is noteworthy about that is that that same survey in March was 25%. That is a remarkable jump in negative sentiment, and you may notice in your statements that you get for April that that did not coincide with any negative events inside of your own portfolios. We think there's a reason that we want to separate the political from the market and economic as a part of this conversation. I would also share with you in the first 100 days of any presidency, interesting things happen. I was reflecting back and looking back and noticed that President Reagan got shot in his first 100 days, and President Bush bombed Iraq in his first 100 days, and President Clinton raided the Branch Davidians in Waco in his first 100 days, and President Obama had to rescue Captain Phillips using the Navy SEALs, who had been captured by pirates. So the first 100 days, maybe a noteworthy comment on the first 100 days is a reminder it's the first 100 days. It's not the entirety of the term. But certainly some things have happened and been moving quickly. It was interesting to us that some of the things, until I had read up on such things, I might have believed personally some data that was erroneous. To wit, President Trump so far has signed more laws into being in his first 100 days than any of his last three predecessors, 29 in fact. The second most was Clinton at 22 laws signed in the first 100 days. Of note, they may be some of the fewest words of any laws passed, meaning I think it's about 7% the volume of words in the laws signed so far this year in the new presidency compared to last year, even though it was twice the number of laws. That's an interesting notation, because most of those laws are stop doing something as opposed to start doing something. Also notably, he's had a higher number of cabinet confirmations than any of the last four presidents. So far, 21 cabinet members have been approved. President Obama had 20 at this time, although he only had a total of 20 that were needed. President Trump has one more to go. And executive orders have jumped a little bit as well, with 32 executive orders signed so far in this administration, which is second in that category would be President Clinton back in 1993. So that type of information falls on us one way. There is a lot happening, but as Ryan will describe in a moment, there's also a lot not happening that maybe had been predicted. So I'd like to turn to you, Ryan, for just a quick update on things that might be more market or policy or economically related, to just summarize what we've seen so far in the first 100 days.
Sure. Thanks, Todd, and thanks everybody for joining us. So I'll kind of start with a recap of market data, talk about some economic data, and then we'll kind of talk about where the major policy agenda is now and where it's headed. Then we'll kind of recap, and then we'll get to question and answers after that. So first, let's talk about market data. So stocks initially started out right after the election, as everybody knows, that night, falling pretty hard globally, and then they subsequently rebounded and actually finished. The U.S. market finished up that night after the election, the day after the election. Since then, it's been a pretty steady run up, and we've had pretty good U.S. earnings. Last year, earnings were up about 0.6% for the whole year, and this year expectations are for about 12% growth in earnings. So much better earnings growth right now in the U.S., which is really, when a lot of people ask, is a lot of the market run up due to Trump? A lot of it is due to this underlying earnings growth. So that's a positive, because when you have fundamental factors pushing stocks higher, that's a good thing. Just want to do, I was looking through the data, and the sectors that we've seen good performance out of since the inauguration, mostly technology. A lot of that has been because of really good earnings out of the what they call the super cap tech names, which would be Amazon, Apple, Google, those types of stocks. We've also seen healthcare has done pretty well. That was the second best performing sector. The worst one so far since the inauguration is energy. That's because it had a pretty good run up going into the election. The price of oil had bounced from the $20 levels up to about $50, and then it had pulled back a little bit ever since the election. So we've had a little bit of a return, a little bit of degradation in energy earnings. So that's probably why it's performed so poorly. Financials had a really good bump right after Trump was elected. If you remember, he was elected on the promise of imposing some deregulation, trying to cut up a little bit of the Dodd-Frank Act. That was going to let banks get out there and lend more to small businesses. And then right after that, right after the election in December, the Fed raised interest rates, and that helped. Raising interest rate always helps bank earnings. So they had a pretty good tailwind since the inauguration. Really, it's kind of leveled off in financials. So those are the most notable sectors. I would say starting in 2017, the shift really, we saw leadership roles in emerging markets and international markets. They took the lead from U.S. markets, which had done best in 2016. A lot of what we see in the economic data shows that Europe is in a pretty good rebound, and that started ever since the middle of last year. It's just continued, and it's getting better. We got French elections coming up this weekend. There's a lot of good sentiment about the French elections coming up, so hopefully the international stocks will stay on this good trend. The U.S. dollar has helped since the inauguration. The dollar spiked pretty hard right after the election, and has since kind of leveled off and even come back in a little bit, which is a help to international stocks. So we're also seeing a little bit of residual help there in international land. Let's talk about bonds real quick. Bonds, in 2016, they trailed the performance of stocks. That's normal in good times, and we're seeing a continuation of that trend. What you see, the best performing sectors in bonds so far have been those that are kind of credit related. High yield bonds, emerging debt bonds, things like that have a little more credit component than what you would see with a treasury bond. Those have done significantly better really since the middle of last year and into this year. Commodities, just talk about that. We talked a little bit about oil. It bounced pretty good in 2016. It's since kind of leveled off a little bit. Gold it ran up a little bit right after the election, but it also has leveled off. It ran up on geopolitical concerns, but it's since kind of leveled off. And then, but maybe the most notable in market data is the volatility level. The VIX index is kind of a benchmark for volatility in the stock market. That level historically has been, average at about 19. Right now it's trading at 10, and that is really, really low. So we've had, I mean, since 1993, you've only seen about 16 times where it's been this low. Unprecedented levels of volatility, low volatility, which is good. That's good for stock market investors.
It's also diametrically opposed to the forecast at the time.
Exactly.
Which was we're moving into a highly volatile world with a highly unpredictable president, which may not have changed, but the market reaction, which is a different type of vote, right? Our vote with our money is different than our vote with our pencil and our coloring in the circle. And the vote with the money has said this has been one of the least volatile times, maybe ever on a risk-adjusted basis for the first 100 days of a presidency, which is a staggering thing to be able to say based upon the forecast and the just the news coverage at the time suggested virtually the opposite of that would be where we are today.
Yep, that's true. And what we have to remind everybody is that volatility, it can stay low for an extended period of time, but it never stays there permanently. So we do have to be careful about projecting that into the future. Things always pop up, and markets always get volatile, and that's why we hold on to bonds in people's portfolios, because they act as that diversifier in times when things get scary. So even though they've underperformed over the past year or so, we do want to maintain that fixed income exposure. Jumping now into the economic data. Really, you can sort economic data into kind of two categories. There's soft economic data, which is things like sentiment indicators. There are also hard economic data points, which are retail sales, auto sales, construction spending, those types of things. I would just say, I would characterize the soft data out there, the sentiment indicators, as they have risen pretty substantially since President Trump was elected. They've leveled off a little bit over the past 30 days, but they're not even below where they were when he first won the election. So sentiment, that's business confidence, it's consumer confidence, it's advisor expectations, are all still running pretty high, and that's a good thing for the economy. When you look at the hard economic data, we still see strong retail sales, which is a really good indicator because the consumer is about 70% of our economy. So that's maybe of single most importance. We've seen a little bit of weakness in some areas like automotive, construction spending, but that's not softness. It's not really, a pullback. It's just a deceleration of the growth trend that was in place before, which naturally happens over time. No industry grows at 20% forever. As that bull market extends, you start to see that growth pattern kind of move back to, just kind of solid economic type growth, 3%, 2% type growth. And that's what we're seeing right now in some of those other areas. Maybe the downside to the economic data was the Q1 GDP number, which came out last week. It was up 0.7%, which is a little bit lower than what people had expected. We're always aware, though, that the first quarter GDP numbers are always soft because of seasonality. I would just note I saw the Atlanta Federal Reserve, they publish what they call a GDP Now number, which is kind of an assessment of ongoing market data. They plug it into their computer model, and it outspits a number that is what they think the current GDP estimate for the second quarter is. That number, and it's always a good rebound number because of the weak first quarter, that number right now is up 4.1% for the second quarter. So, a little bit of softness in the hard economic data currently, but then maybe some silver linings about what's coming, pretty soon. So with that, let's just switch real quick. We'll talk about major policy agenda, where it sits right now, and then we'll have some kind of summary concluding thoughts, and we'll start taking questions. Healthcare, well, Paul Ryan is pushing to try to get enough votes to pass a new healthcare bill in the House right now. So it's currently in process. I believe we're supposed to hear more on that this week. Foreign policy, seems like the new administration has taken a little more muscle stance towards certain countries, Syria, North Korea, Russia. those types of things, those stances, though, they haven't really manifested in any negative market events yet. We would have maybe a little bit of volatility, but I was kind of surprised at how little we had around those events. So,
right, the mother of all bombs being dropped had very little impact on world markets. Had a very big impact on 1 square mile, but did not really reverberate around the world as honestly watching the news that morning I might have expected, which I think is another great reflection of the disconnect between geopolitical events and real-time or even longer-term impacts on portfolios.
Yeah, yep, I agree. Taxes, that's the biggest area of difference right now. It's the the most fresh because it came out last week. I would say there were kind of 6 major bullet points for the personal tax code, and then kind of just a general bullet point from the corporate tax proposal. So on personal tax proposal, we're looking at consolidating 7 tax brackets into 3. The proposal wants to take the highest tax bracket from 39.6 down to 35. They would like to repeal the alternative minimum tax, eliminate the estate tax. They want to increase the standard deduction. They want to take out a lot of the itemized deductions. They're talking about still leaving in the mortgage deduction and the charitable contribution deductions. And then finally eliminating the federal deduction for state and local taxes. So those are kind of the major themes of the tax proposal that was put forth last week. We would note that on the corporate tax rate, the first proposal through is trying to bring that corporate tax rate for corporations, small businesses, partnerships down to 15% from 35%. So it's a good direction to go.
It is a good direction. The timing is probably of interest to us, and particularly as Ryan reflected earlier on earnings. You mentioned 12. I saw an article this morning showing year-over-year growth in earnings of 15.6%. And the common wisdom at the time, to include my own, was that tax reform was really feeding that position, feeding markets. And in reality, it may not be any longer. And these tax reforms that have been laid out, I think it was on the 26th that the president's tax plan came out. I'm just reminded of President Trump's book, The Art of the Deal, where he puts out a lot of data points on the furthest end of the curve, knowing in advance he's going to negotiate for purposes of your own businesses and personal portfolios, like we feel at the moment. There may be a delay here, and where I might have hoped for and projected a 2017 improvement to client taxation, both personally and corporately, I'm beginning to be not as likely to believe that that's going to take place this year. It certainly could. It could happen in the blink of an eye. That's one thing we're learning about this president is nothing changes until everything changes. But for planning purposes, it may be that we wait until the end of the year, later in the year, to even have a feel for whether we have a 2017 opportunity to see actual tax reform take place. I'm also reminded that the markets, being priced where they are beginning to assume the same, that there may not be tax reform this year, and they are not crashing, which is by default a proof point. They weren't trading on that currency. They were trading much more on the earnings.
Yeah, it's a good point. Good point. Couple other things, 4 other things here. Deregulation. Trump has already signed some executive orders in certain spaces, certain sectors like manufacturing and infrastructure. The Dodd-Frank bill, which is financial regulation reform, they have started a process of analyzing that bill and trying to figure out which pieces of it they want to keep and which pieces they want to get rid of. So I'm sure we'll hear lots more on that coming up. The biggest impact of Dodd-Frank reform would be the banks, the financial services sector. So keep an eye on that. Infrastructure spending. We haven't heard a lot about it yet. The administration's had most of their most of their push behind healthcare reform and tax reform. With infrastructure, the thing that you have to keep in mind is that it takes a while for it to play out. It has little immediate benefit other than putting some people to work, but it has much longer lasting benefits to it. And the most important things with infrastructure spending are to create incentives and policies that get businesses to buy in and businesses to invest alongside any government spending that goes into place. So infrastructure spending, I'm sure we'll hear more about that coming up. Nothing really yet on the front burner. Education, we'll just touch on that quick. He's already proposed a $1.4 billion down payment on school voucher program. Again, they're kind of in the draft phase of that. So I'm sure we'll hear more about that coming up. Lastly, one thing that has a little less to do with maybe front burner policies, but something that's important to keep in mind is the impact that President Trump can have on the Federal Reserve. There are 7 board of governors that sit on the FOMC. He has the opportunity to change maybe 5 of those. So a majority of the FOMC, the way that their terms come up, and the fact that there are already 2 vacancies. Chair Yellen, her term expires in 2018. Stanley Fischer's expires soon after that. He has the potential to really shape monetary policy with his nominations for the FOMC. So that'll be really something to keep an eye on over the coming months, 6 months, year. They could have some real impact to the economy.
Probably is a safe bet. As most of you have noted, interest rates have been increased 2 times now. There's a fairly strong forecast for another 1 or 2 this year, and I've read enough commentary that I believe this, that those rates are more returning to a normal rate. I think 3 is a sort of a commonly thought of normal rate of interest, and as the Federal Reserve moves policy rates back up into that space, the reason that we haven't seen much pain in the markets yet is that is tantamount to reducing icing on the cake, not reducing the cake. And until we get to a punitive level of interest rate, meaning where it really changes behavior on the part of businesses, we aren't expecting any particular negative volatility from the coming rate increases that seem already baked into the market, already well believed by the community and the advisory community as a whole, that those are already in the forecast.
Yep. So with that kind of takes care of the market and economic update, the policy agenda and where it stands. Todd, why don't you talk to us about some summary and concluding thoughts about where we sit right now, and then just a quick reminder. There's the box on your screen where you can type in a question and then just hit send, and we'll take those questions here in just a couple of minutes. But Todd, why don't you start us with some summary?
If there is a summary, the first summary is the easiest, and that is 100 days is just can't get that much done. There's no chance of getting all that's done in an election done in the first 100 days, and that's true reflecting back over prior administrations. What I do know is the sentiment of society, and even reflecting back on some of the comments, some of the things we've heard from you, some of the things we've read last August from there through the election, the sentiment was incredibly resolute that a President Trump would have a negative impact on markets, almost to an article that was discussed, that he would have a negative impact on markets, a negative impact on trade, positive impact on volatility, meaning it would go up, and by now we would be at war with someone. And while we've had some of the tensions around that have been very real, President Trump's stance towards North Korea is a good example. While the tenor of that sensation has been real, the markets are actually not reflecting the level of danger that I believe that they did all the way up to the point of inauguration. I might also share from a concluding a few ideas. How does this really translate into our lives? We do believe that there could be some positive surprises because the sentiment now has really changed from election day or even inauguration day. The sentiment, I believe, has changed dramatically from there are a lot of things that are going to change, and if you are in business or an investor, you are generally reflecting favorably on tax rates corporately and personally will come down. Policy will shift from monetary policy, things where the Fed can adjust money or provide stimulus to buy an automobile, for example, to more fiscal related policies where we build things, we sell things globally, to a little different nature to that. I believe much of that has actually been discounted now, and we continue to see world markets really priced in the neighborhood called fair as opposed to high. But activity this quarter, this most recent quarter notwithstanding, projected activity does appear to be moving up. And anything that would be positive on the tax front or the health reform side or infrastructure spending, anything that actually happened in 2017 could actually be a win behind the back of the markets that we now see. I do think that regulatory reform also, with 60% of all job growth coming from small companies, anything that constitutes regulatory reform on Dodd-Frank must almost by necessity have an impact on small business hiring, small business expansion, etc. The thought of that actually happening this year was a given between the election and inauguration. That was a given, and now it would be a positive surprise to maybe replace some of the strength in markets that are coming from earnings, and maybe that's consistent with the idea of moving from an environment where from business community or from an investment community, high expectations following the election, high expectations immediately following the inauguration. Those have been replaced with low expectations, which in the world that we all share together, buy low, sell high, is a theme that you've heard here often. And from a contrarian standpoint, sometimes the best things that happen in this economy or in these markets happen when they are not expected, not when they are expected. And so we are not negative or pessimistic at this point in the year, notwithstanding the wild card that is our 45th president. Certainly there are things that will surprise us, regularly in that space. So for us, our hope is that there is tax reform. We do believe that tax reform would, even if it were 3 out of the 4 years as opposed to 4 out of the 4 years, for Americans realizing that there's a lot of changing who pays taxes and knowing the stated objective to reduce that on the middle class. How that transpires is maybe less important than that transpires, and I believe that will have a significant impact on small business. So for purposes of spending time with you all today, we're thankful for this opportunity and appreciate some of the questions that you may have, and we'll try to speak to those now. And in front of us, we've got a few. One of those. Give me just a second here. Korea. Let's role play that. Unfortunately, let's role play that just a little bit. In fact, I saw it on the news this morning, but one of the questions is regarding Korea and what would happen if, maybe that if is the detonation of a nuclear bomb, or I think it's the USS Carl Vinson that sits over there right now offshore, effectively daring President Kim to pull a trigger.
Yeah. Well, yeah. So it's a fear. It's been a long fear. North Korea for a while, for previous administrations. President Trump, the way that he's addressing it is a little more aggressive than what we've had in the past. I would just say, with a war, here's what happens: you get more defense spending. That would probably come at the expense of any infrastructure spending. We might delay any infrastructure bill if we kind of remove the defense sequester and we start spending more on defense. It'll help technology companies. Defense spending would be in the industrial sector, so you'll see some industrials benefit from that. You know, the geopolitical concerns tend to coincide with a rise in the price of oil and a rise in the price of gold. A reason that you might not see a rise in the price of oil this time around is because of the North American oil fracking boom, where we have, our producers have become so adept at drilling and producing oil and natural gas at a far lower price than we've ever been able to before. So you might not see the same type of correlation that you've seen in the past, where at the start of a war you'd see the price of oil rise. I don't think you'd probably see that happen this time around. The price of gold,
maybe not with Korea. Could be different if it was war in Syria as opposed to war in Korea.
True, yeah, true. And then the let's see, I forgot where I was going.
That's all right. That's all right.
I don't think that it would make a huge impact on the equity markets overall. I think you would just see a little bit of, you know, some sectors outperforming other sectors, maybe some diversion of funds going into different sectors, but I can't see it having long-lasting implications to the U.S. economy or the U.S. stock market. Previous wars haven't had that big of an impact for real long. So,
well, it's another question was raised about trade negotiations, and I'm reminded of the immediate aftermath of the election was that the emerging economies learned that NAFTA may be, in this case Mexico, that NAFTA may be renegotiated, or that a wall may be built, and there was a lot of initial pullback in the emerging economies. But from a trade negotiation standpoint, are any of these things moving now? A lot seems like it's slowed down. Where are we in trade negotiations?
Yeah, boy, right after Trump was elected, the Mexican peso, it felt like a rock. The Mexican stock market was down pretty good. Since then, though, we've seen kind of a softened approach to NAFTA. When you look at NAFTA, the draft proposals that they're discussing right now, the negotiations that are going on from the administration, they include much less harsh terms for Mexico. I don't think there was no mention of any tariffs or any punitive measures towards Mexico. So some of that might have just been some posturing on the part of the president. Ever since then, really, you've seen the peso has risen pretty substantially. The Mexican stock market has come back quite a bit. So, tweaks here and there on the edges of NAFTA, but probably not a wholesale kind of scrapping and starting over with that process. The TPP was the other big one, the Trans-Pacific Partnership. He tore that up, effectively as soon as he got into office. So we're out of that one. That one was really never ratified, so that was an easy win for him to get rid of that one. But those were the two biggest trade deals that were on the front burner.
Let's take another question. It's phrased the Washington effect. What if the Washington effect stalls everything and we go through another 4 years of nothing gets done?
Well,
from a political standpoint.
Historically, that's been a good thing for markets. Some of the best market runs have been when Congress and the president can't seem to meet eye to eye, and they can't seem to pass anything that gums up the gears of the economy. So some of that, some of that process is a good thing. I guess it depends on which stuff doesn't get passed and which stuff we're expecting or hoping to get passed doesn't get passed. All of which is kind of it's tough to say at this point.
Well, it would sure be frustrating. To think of all the opportunity that we have to get something done, but right now I think the consensus has really been this is whatever gets accomplished will be slower than had been predicted, and I doubt seriously that we'd have 4 years of no positive motion, but we certainly could have a few days of it here and there. So let's take one or two more questions, and maybe this one is related to that. But are there any? Does Vegas have probabilities of tax reform actually taking place? How would we know, or can we know, whether or not that might actually happen?
Mm-hmm. Well, yeah, tax reform is a tricky one to get through, and I think most people have. There was a recent presentation. A politician or political analyst had come through St. Louis. I was at the meeting, and he said that he expects tax reform to live and die about 4 or 5 times, just like the repeal and replace of Obamacare did. He said it's a messy process in Washington, and that it just takes a long time to get done. We may not see. I mean, the odds of it happening this year, I don't know, 50%, maybe a little less than 50% of it happening this year, or at least of anything significant happening this year. You could always pass it in early 2018, have it retroactive to 2017. I think what you have to keep in mind, and what this political analyst had pointed out, was a lot of the inter-party food fight that happens right after an election is best held right after the election, because you're far enough away from the next midterm elections that enough voters will forget about you having that inter-party food fight, as he called it. And if you can buckle down and compromise and get some stuff done right before the midterms, that sits much better with your voters. So you may see, a little bit of political theater going on. Some thumbs down, and then as we start to turn the calendar, maybe everybody gets a little more compromising.
Right. So that looks like that handles the questions that came in. Might have a closing thematic idea over the top of this, and certainly if you've got any last-second questions, don't hesitate to type those in. But that theme would be, and it would be a theme that I'm taking the 45th president at his word on this, that it feels as if the theme is moving the United States economy from one of managed growth to one of organic growth, and really trying to populate things down at the seed level to get activity going. And I don't know that we've seen sentiment around that. I don't know that we've really seen the data of organizations growing significantly, and that is our hope. That is our hope for that. And I do see that one more question came in. If tax and regulatory reforms are proposed, the white tail to how likely do we see a very fair question.
Mm-hmm.
The market pullback, maybe it's I hate to go backwards too far in time on this answer, but to put it in a context, certainly there is a market pullback on all of our horizons. I think the question is good, and I think that to the extent that President Trump could be a stimulus for not a pullback and for a pullback, and probably both before it's all said and done. The regulatory reforms that are proposed, almost anything that would reduce regulation on business probably doesn't create a negative market environment. It probably fosters a positive market environment. That's a guess. Certainly we have indications, even going back into 2008, that it was much the regulation on even mark-to-market accounting, for example.
Mm-hmm.
It was regulations in place that potentially contributed to the magnitude of those declines. And as I mentioned in the earlier comments about the number of laws and the number of executive orders signed, many more of those than normal have been stop, not start something new, but stop something existing. Guessing that probably has a long-term positive impact, at least from my perspective.
Yeah,
would be that.
And I would say valuation levels right now are not they're not grossly overvalued. Stocks right now are just a little bit above average in valuation levels. One one could argue with a low inflation rate environment and a low interest rate environment that those above valuation or above average valuation levels are probably more appropriate. So I've also read reports where the Washington impact to earnings this year could be another 10% or so. It add an additional 10% of earnings to corporate earnings. If you did that, that would bring the S&P multiple from a 17.5 times earnings down to about a 16.5 times earnings, which is right in line with the historical average. So, absent any Washington impact to the economy, we are probably at about average, at about an adjusted average. And if we get a little bit of bump because of some of this agenda passing, that could bring the valuation levels to cheap for the U.S. stock market. So
maybe that's the heart of the question that's been asked here, is if they fail to get approved, if there's failure to get any of this regulation move forward, possibly on just an earnings basis, what your answer may have provided the implication, 10 to 12% down move in the markets if nothing got done is probably a better guess than anything else we could come up with by just taking the antithesis of that. And I think that is actually the fear for the longer term viability. I think the question is a good one, and it speaks more to not just 2017. 2017's already been good, but thinking through the duration here, maybe a more intermediate horizon, if all that is being proposed and thought about, if none of it got through, I can imagine that being maybe not a market pullback that would be violent and quick, but certainly a headwind to continued increase in the markets. I think the market's up 12% right now from election day forward in the United States. It's up more than that in a few different places around the world, even.
Yeah, and I couldn't imagine it being a catalyst for a bear market or anything like that. I mean, corrections happen. Corrections are healthy. They're the healthy part of extended bull markets, and they happen almost every single year. A 10% or so pullback comes, and so
I think about that and reminded of what a genuinely high market looks like. And occasionally in our careers, we get to see something that, in foresight, in hindsight, at the time, it's pretty obvious that it's a spike in the market. And I go back to 17 years ago. We were already beginning to move into that market decline in early 2000. But prior to that time, just the bread and butter market, not the NASDAQ, but just the S&P 500, trading at almost 26 times earnings, and us being at 17 times corporate earnings right now. It's a relative scale. A pullback from that is always on the horizon. It's very difficult to forecast that being tied to reform. It's actually easier, for me at least, it's easier to forecast tailwinds to the market coming from reduced regulation than it is to forecast headwinds to the market from new regulation, because I don't believe there will be, on balance, new regulations coming out of this administration. The worst case scenario from a regulatory reform standpoint might be nothing changes, and we're getting through with nothing changed right now.
Yeah, muddling through.
Right.
Sure.
So we thank each of you for taking time out of your day. This will be a link that you'll receive in an email that can be forwarded if you think of someone that might be interested in seeing this. We appreciate the questions that you provided for the discussion, and Ryan and I are thankful. We're looking forward to massive change in some direction to give us an occasion to get back around this table and maybe share a few thoughts. What a gift it would be to have a webinar around, look at the incredible regulatory change, look at the incredible tax change, look at the incredible trade change that hopefully we're not getting together to talk about World War III.
I know.
or other negative shocks to the system.
Yeah.
But
okay.
For today.
Thank you, everybody, for joining, and we'll look forward to seeing you next time.
We'll be here if you need to call in with any sidebar questions. Thank you.